Ma'am.
Okay, group 4.
Okay, 5, 4, 3, 2, 1. Good morning, everyone. I hope you had your breakfasts already. So we will be once again refreshed by the ideas and lessons we have learned this week. Firstly, these are the topics we will be discussing for this very quick talk. And from what we can recall, we are firstly introduced to financial markets. What are financial markets? So these are places where people and companies come to buy and sell assets like shares, bonds, debt, commodities, and other products. This is to help people buy and sell things more efficiently and to help companies raise money more quickly. Okay, as we all know, there are different types of markets present in the economy. We have the physical asset market, in which we can find tangible assets referring to properties, equipment, and inventory. Financial asset market, the intangible ones, the stocks or the bonds. And then next, we have the spot market, meaning on the spot transactions are happening. And then future markets, future contracts are traded to those who are interested in buying or selling these derivatives. And then money market, we have the short-term debt investments, and then capital market, on the other hand, long-term debt investments. And then primary markets, investors or companies are selling their new stocks or bonds to the public. And then secondary markets, where investors buy and sell securities they already own. Private markets, these are investments not traded on a public exchange or market, meaning these are transactions are working directly between two people. Public market, markets in which standardized contracts are traded on organized exchanges, meaning it is known to the people. Next, we have the debt market, wherein which investment in loans are bought and sold. And then equity market, lastly, or the stock market, is the market in which stocks are bought and sold.
Next in line, we have financial instruments. It is a real or virtual document that represents a legal agreement involving kind of monetary value. Typically, financial instruments provide efficient flow and transfer of capital all throughout the world of investors. It is widely used. It is a contract that we can trade in the market. It represents asset on the other entity and a liability or equity in the other. Then we have it can be divided into two types, cash instruments and derivative instruments. Cash instruments, it is easily transferable as the terms cash, it is liquid. Maybe also it can be deposited in loans, such as loans manifested and borrowers or lenders. The value of it is determined directly by the financial markets. Next, we have is derivative instruments. It can be over the counter and it is reliant upon the derived upon underlying financial instruments. Examples of these are interest rates and stocks and bonds. Also, it can be divided according to asset class, which depends on whether it is a debt-based or equity-based. For the debt-based instruments, it is less than 1 year. Examples of these are T-bills and commercial paper. It can be manifested by certificate of deposit. It involves borrowing of funds from investors by issuing corporate bonds, as the term debt what is implying. Then we have equity-based. It is manifested by stocks. It involves selling the part of ownership rights by issuing stocks of the company. Examples of these are stocks, stock options, and it can be exchanges or traded accordingly. Next, we have
So to continue, the stock market is a collection of markets and exchanges where regular activities of buying and selling and the issuance of shares of companies. Basically, the participants of stock markets includes investors, stock dealers, and also the publicly listed companies. Stocks are traded through physical location stock exchange in which it is a tangible entity that conducts an auction market in designated listed securities. For example, the New York Stock Exchange. Also, the electronic dealer based, which includes the over-the-counter market and the NASDAQ. Over-the-counter market, which is connected electronically by telephones and computers, in which provides trading for unlisted securities. Next is the NASDAQ, a global electronic marketplace for buying and selling securities. Now let's proceed to the stock market efficiency. It is when there is a fair pricing practices and transparency in transactions. If markets are efficient, there is no way to beat the market because there is no undervalued or overvalued securities available, which means that the price you paid is the right price. Basically, the share prices are set through an auction process where buyer and sellers place bids and offers to buy and sell. Also, it might be affected through different factors that includes projected performance, which was evaluated through IPO and its present value.
So what is financial institution? So basically, we can define financial institution as an organization and establishment that processes financial transactions. Next slide, please. Here is a short overview on the list of financial institutions and the summary on their roles. First, we have the central banks. It conducts monetary policy, regulates banks, and provides financial services. Then the primary function of a commercial bank are accepting deposits and also lending funds. Internet banks, of course, it provides banking services from any place with access to the internet. And then the credit unions, a financial cooperative that provide traditional banking to their members. Then a brokerage firm act as a middleman between buyer and seller. Insurance company, of course, it insures its customers against certain risks, example, car accident. Then mortgage companies, it fund mortgages for residential and commercial property. Then the savings and loan association. It is similar to a bank that specializes in helping people get residential mortgages. Then we have mutual funds. Of course, it pulls money from the investing public and use that money to buy other securities. So remember, all of which have different primary functions and assist with the transferring of funds from investors to companies in need of funds. That's all for the financial institution.
Now let's proceed to the second to the last topic, which is the capital allocation process. So every individual, businesses, and even the government needs capital. That leads some of to get a loan or borrow money, which in results pushes them to pay the interest. On the other hand, some individuals and firms' income also exceed its current expenditures, resulting to a surplus that leads them to invest it. They also expect that they will have a return of their investment. So in a perfect world, the cash flow would involve the two sides mentioned a while ago. Now, the transfer can be described in three ways given. First is the direct transfers. As shown on the diagram, the money and the securities of each side are given directly to the other without going to other financial institutions. The second one is the indirect transfers through investment bankers. So as shown on the diagram, it merely passes through the investment banks first before it reaches the recipient. The third one is the indirect transfers through a financial intermediary. So it also passes through financial intermediaries like bank, insurance companies, and mutual funds before it reaches its recipient. So the intermediary obtains the money and in return offers to buy and hold securities. So the next topic would be about behavioral finance theory. So the logic behind the efficient market hypothesis remains one of the cornerstones of our modern finance theory. So if the stock price is too low, then the traders would have the advantage in playing the price. But if the stock price are too high, they will push back the prices. So in many events in the real world, it seems inconsistent with this hypothesis. So which has spurred a growing field called behavioral finance theory. So according to Professor Richard Taylor and his colleague Nicholas Barberi said that the bias of behavioral finance is overconfidence. Second is self-attribution, which is taking the credit, and if something was wrong, they will blame it to their luck. And the last one is the hindsight bias, which is a prediction of the past before it happened. So thank you. That's all for Group 4.
Okay, so we hope we are all refreshed with this very short summary of our lessons this week. Thank you for your time.
All right, thank you. A quick question for Group 4. In your presentation, the commercial paper was mentioned. Can you tell us a little bit more about commercial paper?
Hello, ma'am.
Yes.
Commercial paper, it is a financial instrument that is issued by large corporations to meet a as a short-term debt obligation, ma'am. It is backed up by an issuing bank, and is promising to pay the face amount in the specified maturity date on the specified number of notes.
Okay. Based on what you've said, how is that different from a bond? How is the commercial paper different from a bond?
Ma'am, it has a different maturity date because it is treated as a promissory note, which has a fixed maturity date of 270 days, unlike the bonds which last more than a year or two, ma'am.
All right. Okay. Thank you.